Do you heed, if you're a retail investor, Warren Buffett's advice, or you buy into the hype today?
I think it's always smart to listen to Warren Buffett, particularly when he talks about the stock market. You know,
what
Sarah,
about
I think
Lyft?
I mean, look,
how does it look to you? I mean, signs so far look good, right?
It is a great deal for Lyft, right? The company is in this battle with Uber, and we've talked about this on other shows, that the challenge for those two companies is that there isn't room for both of them to participate and be profitable. So it's a little bit like what we saw with XM and Sirius, where, you know, they need to raise a ton of money. They're going to beat each other up like crazy. And so this is a fantastic deal for the Lyft management team and for the early investors. I think for the public market buyer coming in today, this is going to be a lot dicier. And because it's the first one out, it's not crazy to imagine the stock does well initially. But in the long run, they have this fundamental problem. It's not a profitable business today, and they have a really well-financed, much larger competitor. And the two of them, I think, are just going to have to slug it out until one of them either runs out of cash or the two of them merge.
It's funny, Roger. John, remember I did mention XM and Sirius to you yesterday, I think, yep, on set as something that we could see. Of course, you always wonder from an antitrust perspective whether it could ever be allowed years down the road for these two to get together. But near term, John, did you hear anything from the interview with Andrew earlier or anything you've done in your work that does indicate the path to profitability perhaps will be sooner than investors expect?
No, David, in a word, no. I didn't. And here, I think, for investors is the conundrum. On the one hand, yes, Warren Buffett, greatest investor ever, et cetera, but you shouldn't follow him on the likes of Amazon. He didn't see that coming. And I hear a lot of people talk about Amazon when they talk about the fact that a company like Lyft isn't profitable. But if you think about what Amazon was doing all those years early in its public life, it was building this logistics network that was unique, that nobody else had. It was the foundation of Prime. And I think you got to ask yourself, with all these losses, what is Lyft building that's going to put it in a unique position versus Uber and everybody else? I do not think they've done a great job explaining that, especially because a lot of what they've been spending money on is marketing, driver incentives. A lot of those same people they're marketing to can also use Uber very easily. Those same drivers drive for Uber as well.
Well, they say they're the nice version of Uber, and they capitalized on some of Uber's flops in the last year. Are you saying, John, that doubling of revenue growth that we saw is unsustainable?
Well, I'm saying that infrastructure and competitive advantage goes beyond nice. I'll tell you what, Uber got a lot nicer since Dara Khosrowshahi showed up, a lot nicer than I thought they could get in that amount of time. So that sort of cultural and feel issue can change very quickly, for better or for worse. If Lyft stops paying these kinds of incentives to drivers, we'll see how they feel about them versus Uber once the public markets have their spotlight on them and they're under that kind of pressure. But I think as an investor, that's what you really got to be thinking about as you look through this S1, as you think about whether to invest or not. What's the sustainable competitive advantage? What is Lyft investing in with all these losses?
Yeah, you know, Roger, when it comes to Uber, which investors will be able to probably make a decision about pretty soon, the businesses such as Uber Eats or Uber Freight, do they, in your mind, sort of change the equation there in terms of a comparison with Lyft?
Yes, so David, I think we now have a new rule, which we add to the Warren Buffett rule, which is investors should always listen to John Ford. I completely agree with what John just said. And so I think all the ancillary businesses at Uber actually have a lot of interest. I do think this notion that there are delivery services that can be delivered economically to the consumer that have real value, that's a no-brainer. The challenge, I think, on this whole thing is that the scale of these companies, in order to be profitable, has to be simply gigantic. And the market values that we're putting on them today assume that they will be profitable at that giant scale. And I just don't think there's any evidence yet that with two players in the market, that there is enough differentiation for that to work. And from Uber's point of view, whether it's Eats or any of the other ancillary delivery services, they aren't a big enough part of the piece to offset the damage of going toe-to-toe with Lyft in the United States and with other players in other markets, you know, every single day. I just think it's a tough business. And as John said, it's not like they're building permanent asset value here. All of this is about competing in the moment.
Yeah, I know, but John, at some point, John, when you make that move to autonomous and the costs potentially decline dramatically, I don't know who owns the fleet of cars, but maybe it's some sort of leasing arrangement with a REIT-like structure for that. You would think these businesses look a lot different. Now, I don't know how many years that is away, but you could probably start a discounted cash flow model and, pretty soon.
Sure, and you got to ask yourself, how long-term are you prepared to be as an investor? Are you willing to wait 5+ years? Some years it might look pretty bad. I mean, if you invested in Snap, how are you feeling about that? It's still relatively early in the game for them. They're not looking too hot. They were kind of in the Lyft position versus Facebook, although they didn't come out first, kind of a second-tier player, but one who a lot of people thought, hey, well, they look better than Twitter, growth-wise. They've got some unique things going on, a very unique founder, CEO in control. So how long are you willing to hold your breath? How much faith do you have in the leadership, their vision, and again, what it is that they're investing these losses in? I mean, $900 million, that's a lot of money. That's a big hole that they're going to be digging themselves out of if they succeed.
And David,
I'm so glad John brought up Snap. Roger, can I just ask you a quick question? Because I think Snap is indicative of the fact that today doesn't necessarily determine what kind of investment it is. I went back and looked in 2017. First day, Snap closed up 44%. It's now lost 2/3 of its value.
Well, no, Sarah, this is so correct. And John's making a really important point about the driverless car thing. I believe the time horizon for that is substantially longer than the bulls would have you believe. The history of automated vehicles, which we've seen with airplanes and we've seen it with large ships, is that you need to have special lanes. You need to have all kinds of, essentially blinkers everywhere to make sure the thing doesn't run into stuff. We haven't made any of the changes to our transportation system to support it. And so I think there's a lot of hope built into this valuation. And there may be a lot more that goes into it when it starts trading, right? I mean, sir, your point is exactly well taken. People could be so enthusiastic because it's the first new IPO of this scale since Facebook. And, they may run the thing way up. But if they do, there's going to be a lot of money to be made when it comes back down to earth.